investment risk that affects your life versus investment industry risk. So this is a direct head-to-head comparison of two different outlooks on the world and outlook on investment risk. So how you define risk can actually make or break your retirement much more than you know. And I'm going to show you that in this video. It's critical. The defining risk is critical to decide on the best investment strategy for you. You're going to find out in this video why people with the right outlook on risk retire comfortably and others do not. So this is a really important topic for you to understand and one that I'm really passionate about. So here's our topic. What we're going to learn today is how does the investment industry define risk? What is investment risk that affects your life? What is that? What's wrong with the investment industry definition of risk? How does this difference affect your investment strategy? How does thinking properly about risk help your retirement? Why do almost no Canadians retire with their desired retirement? And it's surprising how few do. How can you learn to think properly about investment risk? And I'm going to show you how your interactive plan shows you how clearly investment risk affects your life. So that's what we're going to talk about today. So how does the investment industry define risk? So risk, when you go see a financial advisor, first thing that they're usually out with is a risk tolerance questionnaire. And you fill it out and it says you're moderate or you're conservative, whatever it is, and that's your risk. And that's who you are. That's how they define you after that. And the problem with it is they're just thinking about short-term risk. The way they define it is short-term fluctuations. It's risk of a market decline. That's what they're worried about. So they use the official measure they use is called standard deviation. It's a statistical measure. Basically, it's a measure of uncertainty is what it is. And, it's a very, believe it or not, it's a very over-regulated industry we have here. Like you may not think of that as a client, but, for the advisors, we'll say it's just so many rules. There's constantly more rules. And what happens is they're mostly concerned about the compliance officer and complaints. And, financial advisors are actually more worried about complaints and their compliance department than they are about you and your retirement. That's why they tend to favor this definition of risk, which is what compliance imposes on them. And what happens is they try to force bonds on all investors because of compliance and marketing. You find they always have to have some sort of, some growth, some defense, and that way they've said they've done their job in, protecting you. So that's how the investment industry defines risk. So now what is investment risk that affects your life? What is that? This is the risk of not achieving the life that you want. So this is the risk, the definition of investment risk that is really important to you, that matters to you. So it's a risk that your long-term return does not give you the life that you want. So for example, let's say you have a financial plan that includes an 8% rate of return to have the retirement what you want. So you need to make 8% as part of the retirement plan. So then the definition of risk is the risk that your long-term 30-year return is below 8% a year. So that's risk. So if it goes up and down, up and down, up and down, but it gives you 8% a year or more, then that's fine. You get the life, you retire eventually, you get the great life that you want, then it works for you. That's the definition of risk. Doesn't matter how much up and down it goes. It matters whether or not you get that 8% or more as a long-term return. So that is the really important definition of a risk. It's very wholesome. It's very holistic. It looks at your whole life and part of you. And it's also a very growth-focused, optimistic view of life. So I find the investment industry is kind of a fear-based panic. Pessimistic is the word. Pessimistic kind of view. We have to protect against, declines when they're going to happen. And here we're thinking, you know what? Market's going to grow long-term. It's optimistic. We're going to go and we're going to live the life that we want. That's the difference about, a really proper way to define investment risk. Now, what's wrong with the industry's definition of risk? What's wrong is it's all short-term risk. So, like markets, investments go down quite regularly. They go down somewhat, but, they recover. So the market's recovered from 100% of declines in the past. That's not necessarily that big of a risk. And so their focus is entirely on risk tolerance, not on investor education, on helping you understand investments, understand risk, and maybe you can tolerate more risk and then live better. It's again focus on risk tolerance and not on your life and not on your financial plan. So it's a fear-based, pessimistic outlook, leads you to invest too conservatively to retire comfortably. I'm going to show you that in a minute. They assume that you do not learn from education or experience. So, once you fill out the questionnaire, that's who you are, right? They assume that you answer a risk tolerance questionnaire It's who you are as a person permanently, and that's who you filled it out. You're moderate. That's why you're always moderate. You have to invest moderate. They don't take into account that, you know what? I can learn from experience. I can learn from education. And then, maybe I can be more comfortable with a bit more of, volatility. And really, it's not actually investment risk. It's actually behavioral risk. The way the investment industry looks at it, it's really behavioral risk. So, the stock market is down, your investments go down. The stock market has recovered from 100% of declines. So that's not actually the risk. The risk is that you will do something when your investments are down. That's what the risk is. It's not the risk of the investments going down. It's the risk that you will do something. Now, if you have a human gut and when it goes down, your human gut will tell you that, oh my God, I should do something. I should protect myself. And some people say, well, my gut is good. Well, if your gut is a human gut, it's not built for investing, right? It's built for fight or flight. It's going down. Oh my God, I got to fear. I got to sell. And so, most investors sell their investments at the low point. 2008, with the big crash, early 2009, the bottom of the market March was the single most time when people dumped their investments. They sold at the bottom. Here you should buy low, sell high. What people with a human gut do is they buy high and sell low. Okay. So that's why the old quote from the War of 1812, we have met the enemy and he is us. The definition of the investment industry really is not investment risk. It's behavioral risk. Okay. So that's why, to me, is, risk tolerance. What is risk tolerance? You have to invest within your risk tolerance. But to me, the risk tolerance is the ability to do nothing when your investments go down. If you do nothing, you got decent investments, they'll come up over time. If you got the long-term growth, you retire fine. All you have to do is nothing. Now, that doesn't sound that hard, right? We have some clients say, my investments are down. I just don't look. That's it. That's all you have to do is don't look. Wait a year or two, it's back up again. So yeah, everything was fine, right? So that's what risk tolerance is. It's the ability to do nothing. And the more you study it, the more you see it, watching it go down, you may panic. But that's why you need a method to be able to do that. All top professional investors have a method to tame their human gut, but you can learn that too. It's just a learned skill. And once you learn that skill, it's probably the single most valuable investment skill, is to learn that skill and stay invested so you reach your goal. This is kind of the picture of short-term versus long-term risk. Okay, so this is what the stock market is. See, it went down, went up, down, went up, but see, it's going up over time. So what happens with fixed income, which are the more conservative, they'll put you in fixed income to lower the risk, the short-term fluctuation of your portfolio. But it tends to be like this after inflation. So you have to, if you're looking long-term, you have to look after inflation. So it's based on, how much purchasing power, how does the money actually go? So, you have investments, they actually went up a little bit, but they buy less because, they grew at 3% a year, inflation was 4 or something like that, or, they grew at 2, inflation was 3. And so 10 years later, 20 years later, you can actually buy less with it at the beginning. So that's real risk. That's actually investment risk. Your investments didn't even keep up with inflation, never mind grow to give you the growth that you want. So the slow, steady decline is the real risk. The decline compared to inflation and decline compared to the return that you need for the life that you want. That's the real risk. This fluctuation doesn't matter as long as you stay with it and as long as your investments make that return you need long term. How does this make a difference in your investment strategy? So, so the risk tolerance questionnaire, they just label you as moderate, conservative, or aggressive, or whatever they come out as, and that's what they are. And most of the time, most people come out moderate. A financial advisor recommends bonds or balanced funds. And the problem is, as soon as you do that, you cannot, I emphasize, cannot retire comfortably with bonds or balanced funds. You just can't. And I'm going to show you that in a sec. Okay. So I have a post from a little while back called The Risk of Bonds to Your Portfolio, Risk of Bonds to Your Retirement. In fact, I declared the death of bonds. And I think that's a very healthy attitude. If you just say that, what, bonds and cash are dead, I'm not going to have them. I'm going to invest for growth long-term because I'm trying to get growth and I'm trying to live the life that I want. I need my investments to work for me, especially after I retire and I'm not working. So this buying bonds, just to, it reduces your short-term risk, but it increases your long-term risk. And it basically makes it impossible for you to have the life that you want. So this is what I call the nightmare scenario. This is like the worst thing that can happen in a financial planning scenario. And it is the typical financial advisor meeting. You go in to see an advisor, they give you a risk tolerance questionnaire, they don't do a retirement plan, they put you in a balanced portfolio and you leave. That is the nightmare scenario. You need to avoid that at all costs. Never get stuck with that. If you do that, you're dead. Your retirement is gone. Bottom line is you cannot retire comfortably with a balanced portfolio. And this, you went in to see this advisor, you walked out of there, and both you and the advisor do not know that you cannot retire comfortably. So isn't that horrible? That is the nightmare. The typical advisor meeting. Okay, how do you think clearly about retirement then? How does thinking about risk properly help your retirement? So what it does is you end up with, usually once you understand it properly, you invest most or all in equities. So much more because you're trying to get growth. Bonds are, so once you have the right look that, risk is the risk that I get less than 8% a year or whatever's in your plan, then you see that bonds are actually the most risky investment you can have because they have the highest risk of a 30-year return below 8% a year. In fact, bonds essentially have a 100% risk. There's just no way they're going to get you 8% a year. So that's why they're the most, bonds and cash are the most risky investments. Okay. That's when you see it properly, you see they're the most risky. Now, often when you do this, when you have the proper view of risk, you may do more leverage because now you're now thinking growth and optimistic. And you know what? Investments are going to make 8. I can borrow at 4 or 5 and it's tax deductible. So, and Smith maneuver doesn't even use my cash flow. So a fair amount of people, once they see it and get educated in it, then they may do more leverage because they're trying to build up growth. And the Smith maneuver is not for everybody, and borrowing to invest. However, it is an amazing strategy for the right person done the right way over the long term. Now, so what happens is with the right view, you tend to think of long-term returns of 7 to 8% a year are now conservative assumptions in your plan instead of conservative being 5%. Why? Because if you're 100% equities, you take 25-year periods of time, the stock market's basically always done 8% a year or more over 25-year periods. It's not an overly aggressive assumption. Now, the stock market has actually averaged 10 or 11%, or 12, depending on index and what period of time. But you shouldn't assume that, you shouldn't put that in your plan because, if you take the long-term average, then you got a 50% chance of getting less than that. So if 8%, the market has pretty well always gotten that. So have a very high chance of getting that kind of rate of return. So see, that becomes a conservative assumption now, not an aggressive assumption. Okay. And you know what? The difference between 8% a year and 5% a year over 60 or 70 years, the investment life, like you start investing maybe when you're 30 and you invest through retirement up till in your 90s. So that's 60 or 70 years. And over that period of time, it's massive the difference that makes. And that's the difference between having the life you want and not. And if you know the rule of 72, so 72 divided by the rate of return is how long it takes your money to double. So if you're making 8% a year, your money doubles every 9 years. And if you're making 5, it doubles every 14 years. So just think of how many doubles you do. Some quick math. Over 60 years, every 9 years it doubles. So that's 7 doubles. So take an amount and double it 7 times versus 14 years. It's doubling 4.5 times. So take the same number and double it 4.5 times. See what the difference is. Like take the investments now and double them 7 times versus 4.5 and see how much difference it makes when you invest effectively. It changes your entire thinking. You become growth focused. You become optimistic about life. That's really how to be successful. And then what's you're far more likely to retire comfortably and with less tax because you don't pay less tax on the on equities. So now, why do almost no Canadians retire with their desired lifestyle? Now, a lot of retirees will say, yeah, I'm living fine. But the thing is that really what the lifestyle that they want? So really, what retirees do in Canada is they settle for the retirement they get. It's not what they want. So we sit down with people, when they're younger, planning for retirement, and we ask them, what is the retirement that you want? And we work it out in detail. So, most financial advisors, if they do any planning at all, they'll say, you need 70% of what you're making now. So you're making 100,000, you need 70,000 to retire on. I don't know, do you? So, that might be that actually is kind of an average for most people. but you're not most people. It's what is the life that you want? So, let's talk about where you want to be. Where do you want to live? Do you want to live like in Canada, in Toronto, where you are now, or do you want to live somewhere else? Are you going to live in your current house or a condo so you can travel more? Or are you going to get a cottage, another property? Like what properties are you going to have? Let's work out. Are you going to have mortgages on them at the time? What's the lifestyle you want to do? You want to do a fair amount of traveling? And what traveling? What kind of trips? Across, cruises or Florida or camping? Or do you want to do, international trips? Like what do you want to do? And what's the entertainment? Do you like golfing or what? So anyway, you think through all the different things that you want to do and design the lifestyle that you want. And then you figure that out ahead of time. And then you try to get that. Instead of saying, well, I'll invest my money, I'll see what I get in retirement. Well, I guess I'll just adapt my lifestyle down to what I get. And then I'm going to tell people I'm fine. So we want to live on purpose, achieve the life that you want. And that's why you need to first design what you want and let's figure out how to get there. So now, why do almost no Canadian retire with their desired retirement? So because they see a financial advisor who doesn't prepare a professional financial plan. Almost no advisors really do a plan. If they do, it's a really shortcut plan. A lot of times they don't work and they just leave it at that. It said I was waiting. People tell me I got a plan, but I don't know where it is, and I don't know what I have to do. Or I got a plan. It just says I'm way short, and I don't know. Advisor didn't do anything, right? Or they just changed some assumptions. Oh, you know what? Let's just say that you made a bit higher return, and let's put inflation at 2 instead of 3, even though inflation has pretty well always been over more than 2. And let's just say that at 80 you're going to stop traveling and stop going out for dinner, and let's just make an assumption. Okay, now it's fine, but that's not the life that you want. Just putting unrealistic assumptions on that make a plan, make the numbers work, doesn't give you a life plan that works for you. So a comfortable retirement does not happen on its own. You need, a good amount of money for it, and it requires some regular and effective investment and a plan so you know where you're going. Now, from financial planning, there is good news and bad news when you do a retirement plan. So the bad news is you need a lot more than you think to retire comfortably. So we do this with, we get kids of clients, like early 20s, and they just want to start investing. And we spend a short little bit of time just giving them some basic education. And at that point, they're probably still in university. Like it's way too soon to do a retirement plan. They're not even into their long-term lifestyle yet. Okay, but we want to give them a picture of what it looks like. So we just kind of show them, like, let's make up a number. You're making 50,000 a year. So let's say you want to retire on that in 30 years. Let's just make up a number. I'm just trying to get them to see it. And then they look and see, what, to retire comfortably, I need $2 or $3 or $4 million. Like, holy crap, that's way too much. Like, how am I ever going to get to that? So that's the bad news. You need a lot more than you think. So the good news is it's a lot easier to get there than you think. So for younger people, I say, well, you know what? You need 2 or 3 or 4 million to retire comfortably. But you know what? To get there, you need to invest, 500 a month or 1,000 a month. And that's it. Once you get your job, you start putting a bit of money away. So that's not a ridiculous, like you're surprised that I can get there with $500 a month. I can get it to $2 million. So it's that kind of thing. That's the good and bad news. And that's why you need a plan. And if you don't put money away, then, of course, it doesn't happen on its own. You wait till you're 60 and then you realize, oh my God, I'm not there. And then I don't have my 2 or 3 or 4 million bucks. And then you're, without a plan, you don't get there. So, and nobody can retire comfortably with balanced or conservative investments. And I'm going to show you some real life examples. Now, I've had these in other videos in the past, but it's just such an important thing to understand this, because everywhere you go in the investment industry, they're going to tell you you're fine. It's safer to have this balanced, modest return and, some growth and some defense and you're safer. And the truth is you have basically zero chance of retiring the way you want. So you need this growth mindset that's an effective outlook on life, because you cannot retire comfortably on a 5% per year return of a balanced portfolio, or the 2 or 3% you'd expect on a bond portfolio. So comfortable retirement requires a 7 or 8% per year return of an equity portfolio. Now, this is just from experience. These are, this is not a hard and fast rule that has to be this, but I've done literally thousands of financial plans for thousands of people, and I see what numbers work and what numbers don't. And 70% of retirement income over 30 years is growth after you retire. I'm going to show you in a minute. That's why you still need to keep this growth mindset even after you retire. So let's take just a few. I'm going to go through this very quickly, okay? But it's really important to understand. Let's just take a look, because most Canadians, haven't actually seen a retirement plan. I get to see what it looks like. So let's say that you're 35. This is a modest plan, right? You're making 50,000 a year. You're a single, and you're gonna invest for 30 years till 65. Then you're gonna live on 40,000 a year. You're making 50 now. You're gonna live on 40,000 a year, and you're gonna get the maximum from all the government pensions. We're gonna count 3% inflation. That's responsible because it's the higher end of the Bank of Canada range, and we're saving for 30 years, and then you're retired for 30 years after that or something. So that's the plan. Now, if you invest in a balanced portfolio at 5% a year, you need to have 1,150,000. To be there, you have to invest 17,000 a year. Now you're making 50,000 before tax. So you have to invest 34% of your gross income to achieve this. That's ridiculous. I know I meet people that have, got their first job at 35 or the second job and making 50,000 a year. And if I tell them you have to invest 17,000 a year, that's ridiculous. So now let's say we say, okay, let's spend a little bit of time. Let's talk about investment risk. And you could tolerate some more ups and downs. So if we can go in with an equity portfolio, average 8% a year, now you only need 775,000. So you have to invest 6,500 a year. That's 13% of your gross income. So that's not even maxing your RSPs. So that's all you have to do to retire. So this, it's not easy, but it's certainly a doable number. This is ridiculous. Like nobody's going to do this. And so it comes down to, which would you rather do? So you need to invest 10,500 per year more to make up for the 3% per year lower return on a balanced portfolio. So, the advisors will go, you need this, balanced portfolio to be comfortable so you can sleep at night and all that crap. But they don't tell you, well, but you know what? You need to invest 10,500 per year more to get up to 17,000 a year to retire. So what would you rather do? Invest 17,500 per year and sleep at night on a low volatility portfolio? Or would you rather, invest 6,500 per year and with some equities that go up and down more, but give you much more growth over time? And they both give you the same retirement. But I mean, this is just a way better life. So here's an example of the same people with, let's say they're married. So it's a couple, 50,000 each. So it's 100,000 total. They want to retire on 40,000 each, is 80,000. So again, they have to invest 30, they make 100,000 a year together. They have to invest 34,000 a year. That's 34% of their gross income. With the equities, 13% of their income. So you know what? Like we really care about our clients when they come to us. We get people like every day or two. I get a note from my blog. Someone's filled out a contact form, looking for a free consultation, and they're pouring out their life. This is where I am, and this is the life I want to be, and I don't know what to do. And they tell me their situation. It's really quite heartwarming, I guess, to hear all this, and then that people are actually coming to look for help. And once we start working with them, like if we're working with you, we want you to have the life that you want. So we'll help you figure out what is the life you want, and let's make something that's reasonably doable for you. So you have to be within your risk tolerance, but risk tolerance is a learned skill. And to me, that what the typical financial advisor should do is it's just uncaring, right? We'll just stick you. The compliance guy say I should give you a balanced portfolio, so I'll put you in a balanced portfolio, and now now you're not going to retire comfortably because obviously you're not going to do 34,000 a year. So very quickly look through, more moderate and higher income. So let's say you're making 100,000 a year, you want to retire on 75,000 a year. Okay, a balanced portfolio, you have to invest 50,000 a year. Okay, now the government pensions are a smaller part of your retirement, so it's a higher amount. So you make 100,000 a year before tax, you have to invest 50,000 of it. Like you're not going to do that. So, however, if you go to equities, it's 19,000 a year. So that's 20% of your gross income. Okay. So that's, your CPP and slightly more. So again, it's 30,000 a year more. So, I mean, what would you rather do in your life? Invest 30,000 a year more, or learn to tolerate some short-term fluctuations of the equity markets so that you can get more growth? Which would you rather do? And that's why, because we care about our clients, I'd rather spend some time educating you, showing you what the market looks like and what the ups and downs look like. And let's get educated on it and see if you're comfortable with more volatility. Means you can invest a lot less. It means you can actually have the life that you want. So this is a couple now, 100,000 each. So 200,000 total. They want to retire on 75,000 each. It's 150,000. So they make 200,000. They have to invest 100,000 of it. That's 50% of their gross income to get this. They need $7 million to retire at that level. Okay, with an equity portfolio, they need 4.6 million. and they have to invest 40,000 a year, 20% of their income. Okay. It's not easy, but that's doable. That's a stupid number. No one's going to do that. So 60,000 a year more you have to invest, or invest with a bit more volatility short term to give you this 3%, higher return. Here's an upscale one. So, we get, doctors and some IT people making 500,000 a year. Let's say you want to retire on 300,000 a year. Okay. Again, you're going to invest for 30 years. So now 300,000 a year in future dollars, you need 18 million to have that lifestyle. You have to invest 265,000 a year. That's 53% of your gross income. Now, if you're making 500,000, you're paying a lot in tax, probably 200,000 or more in tax. So it's 53% of your gross income that you have to invest, versus equity portfolios, 100,000, 21% of your gross income. Again, not easy, but it's a doable number, and it's 160,000 difference. So that's the difference. This is why I say nobody can retire comfortably on a balanced or conservative portfolio. You need an equity portfolio, like a 7 or 8% or higher long-term rate of return. And that is the secret to having the life that you want. And to do that, you need to have the right outlook on risk. So a balanced portfolio, 5% a year. And here in summary, you need to invest 35 to 50% of your before tax income. That's impossible. That's just stupid. Nobody should do this. And like anybody if your advisor recommended a balanced portfolio, to me, it is completely irresponsible for them not to tell you that you can't possibly have the retirement that you want, or figure out, here's the scale down of retirement that you can get. Like, you need to know that if you're going to invest that way. So equity portfolio, you need to invest somewhere between 13 and 20% of your before tax income, maximize your RSP plus a bit of TFSA, or so gets a doable number. So this is just an example of why you need to continue after retirement. So this is, you're investing 50,000 a year, 50,000 a year each, retiring, it's 100,000 a year. So they retire on 80,000 a year. Let's look at what the retirement is actually like. So they invest from 35 to 65, and then their retirement is from 65 to 100. So if there's 30 years or 35 years that they're retired, let's look at the retirement income and where did it come from. So if you're a balanced portfolio of 5% a year, out of your entire retirement, the 35 years of income that you got, 8% of it was the money you put in, 10% of it was the growth before you retire, and 82% is the growth after you retire. Isn't that shocking? Like, almost all of your retirement income is based on growth after you retire. With an equity portfolio, it's even a little bit more. So 8% of what you live on is what you contributed. 4% is the growth before retirement. 88% is the growth after the retirement. So this is, 82 to 88% of retirement income is growth after retirement. And so, the typical financial advisor, to me, again, totally irresponsible, is they tell you that you're retired, now you're old, you need to invest more conservatively. But you know what? Almost all of your retirement is growth after retirement. So 5% a year for 35 years versus 8% a year for 35 years. It's a massive difference in the retirement that you want. So, for our clients, not all, but the vast majority of them that are retired, over 65, actually, we have clients in their 40s that are retired, but, almost all the clients that are retired still maintain 100% equity portfolio. And quite a few of them are actually still doing leverage after they retire, believe it or not. Because, once you're comfortable with it, then, and if it's right for you and it's part of your plan and you're going to stick with it long term, it can work out really well for you. So, and that is, again, the difference. That's how you have a comfortable plan. So this is now, just a comfortable, same thing with 100,000 a year. So 200,000 for a couple, versus they would retire on 150. So again, out of their entire retirement income, between 70 and 80% of it is growth after retirement. And that's why you still need a proper, effective outlook on risk even after you retire. You can't just collapse and say, I'm old, therefore I have to invest conservatively. Therefore, I have to, settle on retirement and cut way back on my lifestyle. So why do that? Like, live the life that you want. So bottom line is, with a balanced portfolio, you need to invest 35 to 50% of your before tax income. It's possible. And you need 70 to 82% of your retirement income comes with growth after retirement. So with an 8% portfolio, invest 13 to 20% of your income. It's basically maximize your RSP plus a bit of TFSA. And it's, 80 to 88% of your retirement income is growth after retirement. but you get it reliably. And the stock market really does that over time. So now, how can you learn to think properly about investment risk? So, how can you learn to do this? So now you see how critical it is and how this is the road to the life that you want. How do you learn to think that way? So the big thing is get educated about short-term and long-term risks of stocks and bonds. I think a lot of people are conservative because of lack of knowledge. They don't really understand what the market is. They think it's risky. They think it can go to zero. Like so, stock market goes up and down, but it doesn't go to zero. So you need to understand how often does it go down? What's a big decline? What's a small decline? How long does it take to recover? Like how reliable is this long term? You need to understand this stuff, right? And then you can make an informed choice. So the other thing is that you could learn is that risk tolerance is a learned skill. Remember, it's the ability to do nothing when your investments are down, and you can learn to do nothing. I know it sounds dumb, right? But you can learn to do nothing. Your investments are down, don't do anything. Just wait. And you know what? You give it a year or two, based on history, 88% of all declines were completely recovered in 1 or 2 years. So like it's almost always comes back very quickly. And I think 100% of them were recovered in 4 years. So that's the worst case. And yet, so you just give it some time and it comes back. And yet it reliably gives you growth over time. So let's take a look at just what that is so you get a clear picture. So this is, a 200-year picture. Okay. So it goes from 1802 up to 2019, 200-year picture. And so this is just investing $1 in the stock market. And what you see is there's a trend line, which on here it's 6.8% real meaning after inflation. So this chart's been updated every year. And so it's usually around 7% a year. So the stock market has quite reliably made 7% a year above inflation. So inflation now is like 5, but usually it's been 2 or 3. So if inflation is 3, stock market makes 10. If it's 2, it makes 9. That's kind of what it pretty reliably makes long term. That's been kind of the long term trend. Okay, and if you look at the graph here, you see the stock market goes up and down, but it's actually the entire last 220 years, it's never been very far from that trend line. Now, you don't experience it that way because remember, this is an exponential chart. Okay. And it's, going by decades. So these are, decades that you're ahead or behind. So like if you zoomed way in this, it feels differently. But this is, the long-term perspective. And I'm showing you this to show you that, this is actually, the stock market is actually really reliable long-term, but not short-term. I had people say, let me try it for a year or two and see how it goes. I said, well, don't go into it that way, because I don't know what's going to happen this year. But I do know over the long term, it's going to work for you. Like it always has in the past. It's not, obviously not guaranteed, but it, always has worked in the past over long periods of time. So why wouldn't it? So bonds is opposite. First of all, the growth is way less. So stocks, $1 after inflation has become 1.6 million after inflation. So here's my joke is, here's how do you become a multimillionaire? You just invest $1 and then live 220 years. That's all there is to it. So, all right. But bonds, it's only $1 became $1,700, 1,700 instead of 1.6 million. That's a ridiculous difference. Right. And see, what you see with bonds is it's nowhere close to as reliable. So, you had, for example, from 1940 to 1980, 40 years where bonds basically went down. And the reason they went down is because these numbers are all after inflation. So that was a period of time interest rates were rising, which is not good for bonds. They go down when interest rates go up. And also the returns tend to be, what they paid out tend to be less than inflation. So for 40 years, you lost money, and it's shocking how bad it is. It's not short. So that was long-term risk. So let's say in 1950, you have enough money to buy 2 cars. You put that money into a 30-year government bond. You wait 30 years, you collect all your money, you take it out, but that money only buys 1 car 30 years later. Okay, so you've lost half of your purchasing power 30 years later. That has happened with bonds, but it has never happened with stocks. Stocks, any 30-year period, you're way up. Okay, so, and that's the difference. Now, the weird thing is we had from 1982 until 2020, interest rates went down pretty well every year, which is favorable, which means bonds had a higher rate of return. So I call that the bond bubble. We had the bond collapse from 1940 to 80, 40 years where bonds just went down, 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 down for 40 years. And then from 82 up to 2020, we had the bond bubble. So, in stocks, we had tech bubble from 1995 to 2000, where the market made 25% per year for 5 years. So to me, is bonds from 1982 to 2020 is like the tech bubble. It's the bond bubble. It's a ridiculous period. We will never, ever see that again in our lifetime, because this rates, we're never going to see 40 years where interest rates come down every year. Okay, it's not going to happen again in our lives. So, and yet, whenever you go to a financial advisor and they show you bonds, they show you, last 10, 20 years, whatever years, or 30 years, they're showing you periods of time during the bond bubble when bonds did well. But I'm going to tell you, whatever the hell they show you, the returns on bonds are going to be lower than that. All right, because you have to go back to 1940 or 50 to get like what the long-term average. You get the collapse and the bubble all the same thing. This chart shows you, this is actually a really good picture of it, because the investment industry uses standard deviation as a picture of risk, and it's basically a statistical measure of uncertainty. It's reasonable, like over periods of time. But the thing is, if you look at after inflation, again, because we're looking at long periods of time, you got to look at the buying power of your money, and you look at different time periods. What you see is stocks. These are stocks, bonds, and cash. Okay, so what you see is over 1 year periods, stocks are about twice as risky as bonds, and cash is even less. And say 2 year and 5 year, they're a fair amount more risky. When you get to 10 year, there's not a lot of difference. But here's the shocking thing: when you get to 20 years and up, 20 years and 30 years, stocks are actually the lowest risk, so the most predictable. So you can more accurately predict where the stock market will be 20 years from now after inflation than the bond market. And if you don't believe me, those are the stats. This is a 220-year, very professional study that's shown this. And when you saw it from the last chart, stocks, they're very close to this long-term trend line. Bonds have long periods of time where they go down, and they're not close to the whatever trend line you drew for bonds. They have long periods of time where they get way far from that trend line. That's why it's over the long term, stocks not only give you a much higher return, but a more reliable return. So as fee-for-service financial planner, we're thinking about your retirement plan. We're thinking long term, and that's what we tend to think of. If you can really think that way, then you see stocks are the reliable, they're the lower risk option, and you get a higher rate of return. So they have a very good chance of getting you 8% a year as a long-term return. Bonds have essentially a 0% chance of doing it. So we see stocks as the safe investment. It gives you the life as you want. Bonds are the risky investment that cannot give you the life that you want. Now, the thing about stocks is that was the good news. They are reliable over the long term. The bad news is there are declines, and they're not insignificant. So, this is a chart here from 1950 till now. And what you see is the declines that have happened. There's been about 10 or 15 of them since then. And, you get some that are around 20. And then, so what happens is every few years, there's a decline of, let's say, 20, 25%. Then you get maybe once or twice a decade, you get a little bit larger. We've got 30 declines of 30, a little bit more, 30 to 40%. And then usually it's once every few decades, you get the bigger ones. The big ones are like over 40%, 40 to 50%, that kind of thing. But usually that's about as big as they get. Okay, the 80% we had was 1929 to 32. The government actually and the Fed, they didn't know how to run the economy at the time. They made it much worse. I don't really think that would happen again. So think of 20% is a run-of-the-mill decline. 30% happens, once or twice a decade. 40% every few decades. But all of these, all you do is do nothing, give it some time, and it comes back. So see, an average bull market is 50. So it's 54 months, 4.5 years. Market goes up 130%, and then it falls for 9 months on average. Almost all the declines are less than a year. And on average 28%, and then we're back into the next bull market. So you have a few down months and then back into the next bull market. So you always got to think of those as buying opportunities. So that was the chart where you see all these big declines. Now this is, if you look at a continuous chart, what you see is despite all those declines, the market all the way goes up. And so I have people that say, oh, you know what? The market went down 25%, therefore you have to make 33% to get back up. Yeah, that's what the stock market does. It's done it reliably. It's done it 100% of the time in the past. So why is that hard to believe? And when you see a long-term chart, you see despite all these declines and even some declines over 40%, the trend line over time is still up, up, up. So we tend to think of every decline of over 20% is a buying opportunity. And if in the last 200 years, it has been the case. Whenever it goes down 20%, then it goes down 20% or more, you buy more there. So stocks are on sale. You got that reduction, that savings. So you got in cheaper, and if you just buy in from there, it's stocks are on sale. So always think of them as a buying opportunity. Now, again, so the investment industry looks at things short-term, fear-based. What if you have a loss? So these are one-year returns of the stock market. See, it's pretty erratic, and about a quarter of them are down, and a reasonable number of down ones. But you know what? Most of them are up, and there's lots and lots of big gains. Like almost 4 out of 10 are gains over 20%. Lots of big gains. But see, this is how the investment industry sees the stock market. It's all erratic. You don't know what you're going to get, big ups and big downs, and they're always trying to predict what's going to happen this year. But so this is how we see the market. 25-year returns. And you see, the stock market has always done well over 25 years. And in fact, in the modern stock market, which started, let's say, around 1930 when they got into cars and manufacturing and consumer products. And since then, we've had a diversified market. And from then till now, the worst 25-year period, calendar year, was a gain of 7.9% a year. That's 8% a year. So that's the worst it's done in a 25-year period. So again, it doesn't guarantee you're going to get it, but if you're in for 25 years, with a decent portfolio, you have a very high chance of getting 8% a year or more, and that's what you need for your retirement plan. So, and you see the market actually does that. Now, stock market predictions. Here's the thing: is I do not know what will happen this year, but I do know that 25 years from now, based on history, the stock market will be between 7 and 17 times higher than today. So, 8% a year, that's kind of the lowest it's done over the long term, over 25-year periods. 8% a year for 25 years, it's 7 times what it is today. It's actually averaging 11, 12% a year. So if you average 12% a year, you'd have 17 times as much money. So don't think about, is the market going to go down 20 or 3% this year? Think of, I'm going to be in for 25 years, and I'm going to have between 7 and 17 times more money than I have today. And that's the way, so that's the secret to living the life that you want. Now, after you retire, again, you go to a financial advisor. Oh, you're old. You have to invest, be more conservative. And there's this, they call it a sequence of returns risk, right? So what happens if the first years after you retire are big declines? What happens then? It kills your retirement. And the thing is, it doesn't. So I actually study this. Like, I'm a math guy. So whenever there's some theory, I always go and test it. Let's do the math on it. So I've got, 200 years here, 150 years of data of 30-year retirements. Let's say you retired in 1880 and you retired for 30 years and you were 100% equities. So this is a test of the 4% rule, right? So I had $100,000. I take 4% a year out. That's 4,000 a year. Was that enough for my retirement that I want? Or $1 million a year, that's 40,000 a year that I get. And I increase it by inflation, whatever inflation actually happened to be back at that time. And did I have that retirement for 30 years? And so it's actually worked 97% of the time in the past, being 100% equities. And that's without any sort of management at all of of your withdrawal rate or what you do. So it's worked 97% of the time. And out of the 5 times out of 150 years that it failed, only once was it because of a market crash. So sequence of returns risk. So 4 times it was because of inflation. So inflation is the big risk. So right now here we have a fairly high inflation. That's the biggest risk. Governments that cause inflation. That's the big risk to your retirement. Market declines and sequence of returns, they are not a thing over a 30-year retirement. So if the market goes down a lot early in your retirement, but you stay invested and you're in for 30 years or more, it doesn't really matter if the big decline is early or late. And we've had clients that retired. They set up a retirement plan. They saved up the amount that they needed. They retired. Everything looks perfect. Turns out it was 2008. 6 months after they retired, they were down 40%. Sounds like the disaster, right? So, but what happened? What did we do? We just kept sending them the amount that was in their plan. In 2 or 3 years, they were all the way back up. And then, actually, it's funny, 2008 was the second biggest decline of the last 80 years, and yet it was followed by the biggest bull market, the longest bull market in history from 2009 till 2020. So it was 11 years of straight up, and those clients are all perfectly fine. A couple of years we have to reduce what they're sending them by 100 or 200 or 300 a month for a year or two, just to manage it a little bit. But basically, what advisors will tell you about you're old and you have to worry about sequence of returns? No, you don't. That's all bunk. You don't have to do it. You need to remember 80% or 80% 88% of your retirement lifestyle is the return after retirement. So you still have to invest for growth. And that's why retirees that invest in equities retire way more comfortably than those that invest in a balanced fund or conservatively, like the financial advisors tell you have to do. Now, let's talk about your interactive financial plan and how clearly shows you how risk affects your life. So, and this is, you only see this when you get a financial plan. This is why it's so important. Again, comfortable retirement doesn't happen on its own. You need to be able to get there. So, what a financial plan does, one of the key things is it tells you the rate of return you need for the life that you want. Okay. So, again, do an interactive, we call it interactive plan because you can do all kinds of changes. So, first of all, you design the life that you want. So we usually start with what you're spending now, but then let's think through what you want to do in your life. Where are you going to live? Are you going to have one property or two? Are you still going to have a mortgage then? What cars are you going to buy? Like one car or two? How often are you going to buy cars? And what are you going to spend on them? Are you going to, groceries? The kids are out of the house, but are you going to entertain more and barbecue more, or what? Like, what are you going to do? And what are your hobbies? Golfing, or is it crafts, or like how much are you going to spend on entertainment? And you're walking around spending money and travel. Like, what trips? Are you going to take big trips, small trips? Go down to Florida for a few months a year, or are you going to spend 2 or 3 months in Europe, or are you going to take cruises, or are you just going to go camping? So think about the life that you actually want to have. Let's put some more reasonable estimates on what that's actually going to cost. We'll increase it by inflation. We say, okay, that's your goal. So now we have the goal. That's what you want. Okay. And then let's work out, okay, this is how you're investing. This is how much money you're putting in. And when the first draft we do of this, for almost everybody, they're just way behind. So if they look at what they're doing today, the way they're investing and what they want to retire on, they're nowhere close. So then you just think, okay, let's just talk about ways you can do it. So first of all, you can learn to invest more effectively, invest for growth. So instead of 5%, maybe 8% rate of return on your plan. And then let's look at your cash flow and see how much you can put in. Oh, and if you do this effectively, you're best off putting your money here or over here. And then, you get refunds. Let's reinvest the refunds, and let's plan it tax efficiently. And then possibly, like, what we often find is you add Smith maneuver into a plan, you're still a ways away, add Smith maneuver in a plan, and voila, you get there. So basically what we do is, like, if you're shorting your plan, you always have 4 options. So one thing is you can just work a few more years. You want to retire at 55. Can't do it. You got to work till 60 or 65. So our software is very flexible. We can make changes like that. In a few seconds, we can tell you the effect. What if you work a few more years? Okay, another one is you can retire on less. And if we don't just say, oh, let's just take 10 or 20,000 off your retirement, we go back to the retirement and say, okay, here's the life you wanted. You know what? You can't afford it. You want to spend 20,000 a year on travel? Sorry, it's down to 10. Like, let's look at where would you trim to get to the right number. Okay, so we work out an actual number so you understand how it affects you. So one option is work longer. Another one is retire on less. Third one is, save more now. Find a way to save more, like spend less now and save more. And the fourth one is do a more aggressive strategy, like a leverage strategy, like Smith maneuver, or do RSP top ups, or RSP gross up strategy, or I don't know, there's lots of different Rempel maximum. It's things that you could do. But so which one of these 4 do you want to do? Let's try to find a way. And what we're trying to find is a plan that's reasonably doable for you, and you're comfortable with it, but it also gets you to the retirement that you want. And you need to see all the different sides of it. So, in the investment industry, all it is about short-term fear and don't be too risky. And they don't tell you where you're going down the road. So you need to be able to see how it affects your life long term. So bottom line, plan your life, live on purpose, and that's how you get the life that you want. So when you have a financial plan, a proper interactive professional plan that's detailed and personal for you, then you see clearly how today's decisions affect, the desired retirement that you want. All right, thanks for listening. So again, what we talked about today is how does the investment industry define risk? What is investment risk that affects your life? The wholesome way of looking at it. What's wrong with the investment industry definition of risk? How does this difference affect your investment strategy? How does thinking properly about risk help your retirement? Why do almost no Canadians retire with their desired retirement? How can you learn to think properly about investment risk? And then we talked about your interactive financial plan and how it shows you clearly how investment risk does affect your life. Okay, thanks for listening. Again, my name is Ed Rempel. My blog is Unconventional Wisdom. It is the #1 blog in Canada for a full-service financial planner. Also have a YouTube channel and a podcast now. The YouTube channel is just edrempel.com/watch. The podcast is edrempel.com/listen. My blog is www.edrempel.com, and just hit contact and you can ask for a free 30-minute consultation if you're interested in talking with us, and just tell us what you're looking for. One of our advisors will call you, and there's no pressure at all. We're just trying to find out if we're a good fit to be able to work together. And if you enjoy this, I really appreciate if you would like and subscribe to my blog, YouTube, and podcast. Share them, like help get the word out. You can get conventional wisdom anyway, anywhere, but come to my blog or YouTube or podcast and learn the unconventional wisdom of what really works. And appreciate your help in getting it out. So thanks again for listening, and we'll see you next week.